Hello, people. It is Wednesday, June 29th, 2022, and we've got a fair amount of news to go over. So we're going to go ahead and start with the Fed. And this was from June 22nd, Powell's testimony. And he reaffirmed the Fed's priority is tackling inflation, especially oil and gas inflation, which is obviously pretty aggressively hurting the average consumer. So that means continued rate hikes in QT. That's the plan right now. And Powell even says he wants to see several inflation prints showing a continued decline, meaning probably at least 2 or 3 inflation prints where the rate of change or just the headline number is declining before he takes his foot off the gas. And he believes the economy and labor market are strong enough to handle that, so we'll see, right? But that is the plan. And now transitioning to foreign markets, the Eurozone specifically. So spreads have been widening significantly, and that is very problematic because it's putting the European Central Bank in a very difficult position as they need to tackle inflation, but they also don't want to risk any sovereign debt crises. Tighter monetary policy is essentially the EU's only tool to fight inflation, but a lot of the European nations are dependent on rates remaining low. In other words, the EU is stuck between a rock and a hard place. They have to raise rates to fight inflation, but rate hikes could ruin countries like Italy, Greece, Spain, Portugal, the PIGS acronym as it's often referred, let's just call it less advanced or more economically challenged nations within the European zone. So basically, the Eurozone can't really run the risk of expanding its balance sheet. It's kind of trying to fight inflation, so it can't backstop a lot of these economically challenged countries like Italy and their bonds. So spreads between something like Germany and Italy are widening significantly, and it's putting a lot of pressure on the European Central Bank. Let's see what else we got. We also have some Japan craziness, as you can imagine if you're keeping up on that story. So the Bank of Japan renewed its pledge to buy as many JGBs, the government bonds, to keep yields pinned at 25 basis points. Japan remains the only major economy still easing, as all these other economies are tightening monetary policy, which is very significant. And that stance has put serious pressure on the yen. That's why we've seen it depreciate, something like 15% against the dollar, which is huge for a major currency. And it's only been, it's not like over several years. That is within the last month or so. So obviously huge move. But yeah, they are maintaining their yield curve control policy. They are really adamant on it. Here, I think this is a graph of the Japan bond buying. So you can see just in recent, 2022, the last couple months, it has just exploded. But yeah, so they're holding strong, and Japan is fortunate enough to not really, at least previously, been struggling with inflation, so they have a lot more room to do this kind of yield curve control policy or to implement it compared to a lot of the other countries that are maybe a little bit more sensitive to inflation. But that is a huge macro thing to keep your eye on. Japan, obviously a huge player, and their stance right now to keep buying unlimited amount of bonds is pretty important. Okay, so let's transition to this week in U.S. markets. So we got, transition over here to the actual charts. So we got the Dow for the week, starting roughly Monday until today, Wednesday, down about 1.7%, SPY down about 2.7%, NASDAQ down about 4%, Russell down a little over 3%, the 10-year yield down about 1% for the week, down about 2% for today. Then VIX up about 2% for the week, nothing crazy. And then the dollar index relatively flat, but close to, let's call it 70 basis points for the week. Here, we'll go through some of these. So this is the Dow right here. We'll just switch to the daily chart. You got SPY. I mean, they're all pretty much the same in terms, like they're pretty correlated, but yeah, we've obviously had some pretty aggressive moves down this week, giving back a lot of these gains. If you look right over here, pretty much for all the indices. Another big news: mortgage rates are approaching 6%. I think we'll touch on that a little bit later, but as you can see, this has been pretty aggressive. Definitely something to keep your eye on. Just going to significantly reduce the amount of money people have, the amount of leverage they can get to buy homes. So, in other words, they can't buy as expensive of a home. But here, let's transition back. So, yeah, this week in general, the market has been relatively muted. Not particularly too much volatility. I think people in general are still trying to parse out just the uncertainty in the macro landscape right now. But we are preparing to wrap up one of the worst first half of the year for stocks in decades. Pretty historic. I mean, everybody watching the market knows that it's been an absolute bloodbath. And so the overall sentiment is still very bleak. It's not looking like any catalyst is coming soon to save us. Obviously, we can still have these bear market rallies, dead cat bounces as they are called. But it looks like this week in general has been somewhat of a break, taking the foot off the gas. And as investors figure out which direction things are headed, at least in the short term. All right, and the next story we got, oh yeah, here we go. So I showed you the mortgage rates, but this is kind of surprising. U.S. home sales actually rebounded in May, despite consumer sentiment at a record low. But considering mortgage rates are approaching 6%, that is very unlikely to continue. Just the money isn't there. I mean, with mortgage rates going up, I think they've more than doubled recently, which essentially means you can afford half as much of a house. I mean, the lower rates go, the more you can lever up because you can afford to, because the interest isn't going to kill you. So you can buy $1 million home, even though you don't have that kind of money to just spend on a home, because you can lever up. But that is changing. So I do not see this persisting, but it's very interesting to see that, how we did have a little bit of a rebound. Definitely something to keep an eye on going forward. So new home sales rebound 10.7% in May. Median house price jumps 15% to about $450,000 from a year ago. But yeah, consumer sentiment still tumbles, so that is obviously going to have a huge effect. It's kind of like the wealth effect. It's partly what the Fed is after. I mean, the majority of their job is really managing expectations, so they kind of want consumer sentiment to tumble to help curb inflation. So you got, don't fight the Fed. They're after housing prices too, and as they raise rates, the mortgage rate is obviously going to follow suit. So I only see this getting worse despite this little bit of a rebound. All right, moving forward, we had Jerome Powell and Christine Lagarde and a bunch of other central bankers talking today at the ECB forum. And this was significant. I mean, number one, this was today, so it's very fresh news. But when Powell spoke today at the ECB forum, he reiterated once again his belief that the U.S. economy is extremely strong. And given that strength, he and the Fed are prepared to focus all their efforts on fighting inflation. He also mentioned his concern is not markets, it's the economy, which is huge. It's not very central bank, not traditional central bank rhetoric to disregard markets that way, but Powell is very different. He's definitely more attuned to, with regard to previous one of my federal chairs. So I don't know if he's going to be the savior of markets. He's definitely not. I mean, he's openly saying it. He is not particularly concerned with markets. That comes secondary, maybe even tertiary. He just is focused on the economy. He wants to get back to the 2% target rate, to reinstate some semblance of price stability, and market conditions will not really steer him away from that goal. He is going to remain steadfast. He wants to focus on the economy and economic conditions, not so much the market. So this idea of a Fed put is not necessarily in the cards, and I don't think people should really be banking on it. I mean, he is openly saying it. This isn't even like cryptic or read between the lines. He is saying that the market is not his concern. He is here to tackle inflation, gas prices specifically, and to try to help the economy, like the average person, which, honestly, I can respect that. I understand that is really the goal. It's just kind of hard to, you get so distracted by the markets that tends to be this kind of implicit third mandate of the Fed, but he is definitely focusing on the explicit ones, more specifically the inflation price stability mandate. All right, so let's transition to foreign markets. So we'll go back to the charts over here. So we'll start with, we'll go to Forex. So Euro USD down about close to 1% for the week. Definitely showing some weakness. I mean, we already had a pretty steep decline here earlier. Seems to be continuing. We got this around parity with the dollar, around that 1-to-1 with the US dollar level. Obviously a lot of support. Who knows how long that will remain support. It's looking like it could be testing that again. Obviously significant. We'll be watching that. European Union is not in the best state right now, so we'll see how the euro goes. Probably not going to be holding too strong, especially against the US dollar. Now let's go to some of these indices. We'll go back here. All right, we got so the UK actually doing all right. I mean, obviously it had a huge drop, but for the week up about 1% just from here. But if you go back until the previous end of the week, obviously had this huge move. The German stock market, which is arguably the most important in the European Union, down on the week, a little over 1.5%, 1.6-ish, showing some weakness. We'll see how that fares. Got this support around 12,400 level. And then the big, we talked about the USD yen, still showing a lot of weakness. I'm probably going to continue. I mean, I don't see the the Bank of Japan really backing off its yield curve control anytime soon. I think they're going to have to see a lot more yen weakness and just a lot more pressure from the outside world. We'll see how that plays out, but it's not looking good. That said, the yen is only down against the dollar about 75 basis points this week. At any moment, though, you could always see a huge another leg up. Really depends. Then we got Japanese markets. Where are you at? So in a more or less consolidation, I guess. Pretty flat on the week. Had a little bit of a bounce from this area, but only up about 25 basis points for this week right here, just these 3 days. This is a daily chart, keep that in mind. But nothing crazy. No huge moves. I mean, I guess this this big drop beforehand, but still in this general range right now, range bound. And let's see, and then we got the US dollar and Chinese yuan. Also range trading, had a pretty large impulse up. I believe it was largely due to the easing related to their COVID policy, COVID zero policy, but now we're in a range again. China is more or less pretty much in a recession. I feel like that's pretty confirmed at this point. So could definitely see some deflation. Although, obviously the United States is tightening as well, so hard to see which is going to outpace the other. But as of right now, we're range bound. Could probably be a little while more consolidation before a new upward or downward trend is established. We'll see. And then Chinese markets, we got also a little consolidation. Definitely been showing weakness lately. Obviously, China is in a recession, so until the trough is in, equities probably not going to fare too well, but wouldn't necessarily be a bad idea to start looking for buying opportunities in the coming months, or whenever it seems like this market could be bottoming, because we are definitely at a pretty key range low right here. But we'll see. All right, now let's get to some of the stories. I mean, this is the most important stuff. So we got I don't think I have the article in here, but we'll get to this Russia one in just a sec. One of the big stories I want to talk about is related to the ECB and the credit spread issue with, between the PIGS nations and Germany, Austria, some of the stronger economies within the Eurozone. And to avoid expanding its balance sheet, the ECB is kind of toying with the idea of selling German bonds to buy Italian bonds, because they can't expand their balance sheet, through QE by just outright, printing bank reserves and just buying bonds that way. So they're trying to come up with some balance sheet tactics to work around this without expanding their balance sheet. And they thought, what if we take the opposite of this trade, where, because people are selling Italian bonds and not necessarily buying German bonds, but selling Italian bonds at a much higher pace and volume. So they're thinking, what if we just took the opposite side of this trade? We, backstop Italian bonds and target these spreads, or keep them tight, or at least tighter, by selling German bonds on our balance sheet, which would increase the yields, and buying Italian bonds with what they sell. So it's essentially like an asset swap. They sell the German bonds, buy the Italian bonds, and in doing so, they'll help tighten that spread, take the opposite side of this trade that's leading to the spreads widening, which, it's a little crazy, some of these tactics, but that is something they're toying with. We will see how that works out. Wouldn't be surprised if at some point they're just forced to backstop, whatever Italian bonds or some of these other countries. But that is something they are thinking of or considering doing right now. But yeah, now let's get to this Russia story, because this is kind of a big deal. A lot of headlines talking about how Russia is experiencing its first debt default since, 1918 or something. And this is not really true. It's more of like a headline, because the only reason they're unable to pay is because of the sanctions. They are able, technically, they have the money and are willing to pay, but the sanctions that froze Russia's FX reserves are leaving them unable to pay with the dollars they need to. They have like $100 million in interest due, or it was due on May 27th, and Russia is willing to pay that in rubles. They have rubles. They can print rubles if they want. They offered to pay rubles. They even initiated a wire transfer of the $100 million to pay their debt obligations. Since they don't have access to the dollars, they're basically just saying, hey, we'll pay in rubles. And they do have the money in dollars. They just don't have access to it because it's frozen, essentially. But yeah, so they tried to initiate that wire transfer to pay off that debt in rubles, but the attempt was blocked, as there isn't like a clause that allows payment in rubles for these debt obligations. So just to be clear, headlines will read Russian default, but they have the funds and are completely willing to pay. The world, or the US, the Western world, is simply blocking them from paying. So it's, don't get it twisted. They haven't technically defaulted. I suppose you could say like nominally, just because they aren't paying they aren't paying their debt obligations in dollars, but they could if the dollars that they technically own, they have, that were frozen. If they had access to those, they would definitely be able to pay. and they're also willing to pay in another currency. So hard to really call it a default, but I suppose technically it is a default. He's getting all puffy. A lot of people saying he has cancer. I don't know if that's true, but could be partly why he's getting a little crazier these days. But I digress. That's neither here nor there. All right, let's transition to commodities. So before we get to the story, let me just run through the prices. So oil's up about close to 5% this week. Definitely catching some bids. We'll get into some of the reasons why. Natural gas also up about 6%. Pretty volatile, and honestly, natural gas has pretty wild price swings these days, so it's not as significant as it sounds. Gold relatively flat, down, call it 0.5%, nothing crazy. And then we have silver down about 1.5%, really just a, kind of like a leveraged version of gold. That's how silver usually trades. Some bigger news, so copper down 25% since its March highs, which is pretty significant. Copper is kind of a correlate to economies just because it's used for a lot of electronic devices, and when economies are hot, copper demand is higher. And a lot of this has to do with China headed into a recession and its demand as a huge commodity consumer declining. Same with aluminum. Aluminum down about 37% since March highs. Another pretty significant decline in a industrial commodity. But yeah, let's get to this story. So, like I mentioned, there are a lot of recession concerns, a lot of talks about recession, and so commodities, industrial metals, specifically like copper and aluminum, due to their cyclical nature related to the booms and busts of economies and just the demand for them, it is leading a lot of hedge funds, a lot of investors, a lot of economists to believe that that commodities are maybe in for continued downside, just because they are very cyclically driven. And if you got big economies like China heading to a recession, the U.S. potentially heading to a recession, demand for commodities is obviously going to decline. And we're already seeing that, as I mentioned, with copper and aluminum, and there's plenty of other commodities that are struggling a lot, really in bear market territory. I mean, obviously, aluminum down 37%, pretty clear bear market. But yeah, so a big part of this really has to do with China, just because they are such a big commodity consumer. If they're in a recession as one of the biggest commodity consumers, then that is going to bleed into commodity markets, and why we got, hedge funds saying that there's a crumble in the commodity market that is really motivated by recession concerns. So what else we got? That was a big one. So G7 nations are exploring a ban on the transportation of Russian oil that has been sold above a certain price. So essentially price controls. And for anyone that is familiar with economics and just the danger of price controls, this is not good. I mean, it could just really lead to more of a shortage with oil, but this is what our amazing leaders came up with. So I don't know how that's going to work out. If anything, it's probably going to make oil prices go up even more, which would end up benefiting Russia. But the idea behind this is they want to cap prices to try to limit how much money Russia is actually getting, because that money funds the war chest, it funds their efforts in Ukraine, so they're trying to come up with some way to combat that. But yeah, so the idea behind this cap is to tie financial services, insurance, and the shipping of oil cargoes to a price ceiling. So yeah, price controls. We will see how that evolves. That does not sound healthy. It sounds like we're going to create more shortages. And if that wasn't enough, Saudi Arabia is our next story. So Saudi Arabia and the UAE, the United Arab Emirates, unlikely to boost oil output. And they're obviously a huge part of the oil supply in the global market, and they aren't willing to boost supply. That has serious consequences for price, because less supply means prices are going to continue higher, at least stay relatively the same, assuming demand stays relatively the same. Although, recessions could lead to oil demand declining, but in either case, this is not a good sign for, oil prices going down because they are not increasing supply. So that is a big deal. We're going to have to, hopefully that doesn't, well, I guess it depends on what side of the oil trade you're on, right? I technically am long oil, so in some sense I would want it to go higher, but I'm also paying for gas at the pump, so not particularly excited about that. But yeah, that has serious implications for the oil price in the coming months. If they're not going to add more supply, that is obviously a big deal. But enough about commodities. Let's transition to crypto. So the total market has been down about a little over 5% this week. Obviously a lot of turmoil over the last few weeks, even months, just absolutely devastated, down like 70-80% from its highs. Pretty crazy stuff. Bitcoin this week down a little over 5%, ETH down almost 8% this week. Alts as a whole down about 5%. Very interesting how it's a little less volatile than Bitcoin recently. Not sure what that's about. You'd always obviously would think it would be the opposite, as with Bitcoin being the quote-unquote safe haven within the crypto space. But yeah, let's transition to the first story. So Solana recently launched a new smartphone idea to help. I honestly don't really understand the purpose of it. Kind of random, to be honest, especially bear market news headline. But this ended up. Maybe I'll switch to the chart real quick. So this led to a pretty sizable move up, but that has since just completely vanished. So after this, you can't even tell on the daily chart, but so it had a pretty big boost just for a cool second, but since then, like during the last 3 days, the start of the week, we have seen a pretty sizable move down, about 14%. But yeah, something to keep an eye on. I know Solana's doing some interesting things. The Saga smartphone. This is something that I basically think the industry needs to do. We didn't see a single crypto feature at Apple's developer conference 13 years ago after the life of Bitcoin. So they're trying to integrate the crypto into phones, and I guess this is their first step. We'll have to see how that works. They're obviously battling pretty powerful incumbents with Apple. That said, if they're not entering the crypto space, it's a niche thing, so we'll see. So I think it's time for encryption to become mobile. Anyway, something to keep your eye on. Maybe slightly bigger news. Coinbase launches its first derivatives product with nano Bitcoin futures contracts, sized at 1/100th of a Bitcoin. They're also discontinuing Coinbase Pro and will migrate the Pro services onto its new advanced trading section. However, even more importantly is this right here, a message from Brian Armstrong, the CEO of Coinbase, and they are laying off 18% of the workforce. Pretty significant news. Definitely some bear market shit going on, but yeah, 18% is not a small number. I forget, what is he? No, does it say specifically in here? 18%. Yeah, it might not specifically mention. He's probably smart to say that. Because this is actually from him himself. Oh, he does say here, yeah, by about 18% right here. So that is, that's almost a fifth of the entire workforce that he's going to be cutting out. That's a huge deal. Crypto in general is just getting hammered lately. The market turmoil is having serious implications for a lot of these, even big players. Coinbase is considered probably one of the safest. They're a publicly traded company, huge. So 18% of the workforce being laid off is significant. And actually, we have a lot more crypto stories to go over just because it's been pretty crazy. So this next one is a huge deal, part of the contagion going on after the USDT Luna meltdown. So crypto hedge fund Three Arrows Capital has a liquidity crisis essentially, and like I mentioned, they had some exposure to USDT. And after that collapsed, now they're having some liquidity and solvency issues. Guy's face. But yeah, so Three Arrows is one of the most prominent crypto hedge funds and has seen billions of dollars wiped out in recent weeks, which is pretty crazy. And that has led to a default on hundreds of millions of dollars worth of loans. A big part of the fund's insolvency was due to its USDT exposure, and I'm sure this is not the only fund or crypto industry that is going to, or crypto company that is going to have issues with this. I mean, the contagion is just slowly spreading, and a big problem with this is, this is one of the biggest, most prominent crypto hedge funds, and with them failing, like even if other companies or other businesses didn't have any exposure to USDT, they might have been lenders. They had loans that they gave out to a hedge fund like Three Arrows or whoever else who did have exposure. So that's part of the contagion that can lead to these massive domino effects. And speaking of, the next story we got here. So part of this contagion crisis has led to Sam Bankman-Fried, the CEO of FTX, having to become a sort of lender of last resort for the crypto space. I mean, he's obviously pretty well capitalized with, massive crypto billionaires, Alameda Research, also obviously very well capitalized, and they are issuing a lot of lines of credit. So specifically to BlockFi, $250 million credit line to help facilitate solvency and just kind of overall balance sheet strength. And then even crazier, he committed $500 million in financing to Voyager Digital, which is just a crypto brokerage. Hard to say if this is the end. There's going to be more lending. But he is, right now, he's kind of like the JP Morgan of 1907 era, where he was backstopping a lot of the banks because there was no lender of last resort back then. It was before the Federal Reserve existed. And obviously the crypto world doesn't have a lender of last resort. It's kind of the wild, wild west. So, he is stepping in and basically trying to save a lot of these companies from the contagion and the liquidity issues that are arising. So we'll see how that develops. It could really spark some serious concerns just because you never like this, especially when it's not the Fed. I mean, a lender of last resort, when it's the Fed, at least they can print unlimited amounts of money. Presumably they are the backstop that can't be moved or, will always be there. He is definitely not, he can't print his own money. He is not as capitalized as the federal government. So he can't do this forever. And I'm sure he wouldn't want to. He's not going to want to save every company in the crypto space. But this is a pretty sizable backstop, and this is a very important story to follow. Look, they'll play it off like this is part of some strategic thing, but these guys are just struggling to be collateralized enough to facilitate the normal business operations. But yeah, that is what's going on in crypto. Pretty interesting stuff. I mean, this is kind of the problem with a nascent industry that isn't regulated. There's strengths and weaknesses to it. Who knows how this is going to end up with maybe more regulators stepping in. But that is a story for another day. So that pretty much sums it up. Let me just go over some of the maybe upcoming things to keep an eye on for next week. Obviously, I have another video coming out, but just to keep your eye open, tomorrow, PCE inflation numbers on the 30th are coming out. Here, let me scroll down to it. Yeah, so any inflation number, CPI is definitely the most referenced and notorious, I suppose, but PCE inflation is, in my opinion, pretty important, if not just as important. Or at least close to. So those numbers will be coming out tomorrow. Definitely want to keep your eye on that. The next Monday is July 4th, so markets will be closed. Get a break from the bloodbath. Not in crypto, but for U.S. markets at least. And then on next Friday, the 8th, the non-farm payroll report will come out. So we'll get some fresh unemployment numbers. But yeah, that about sums it up. I'll keep you guys updated for next week, but in the meantime, stay happy, humble, and sharp. Best of luck.